Hi, welcome to another edition of Ask Spurrell CPA. Today we're talking about accounting for loans and capital leases. I have Cole here with me again. So Cole, how you making out in your studies lately?
Good. Got a final coming up at the end of April, so it's gonna be pretty stressful. But
End of April. Are they gonna make you right on April 30th with the deadline?
27th, I said it for.
Hey, that's all right. Okay.
Yeah.
So the quote here, Michael Gerber quote, author of the E-Myth. The fatal assumption is if you understand the technical work of a business, you understand the business that does that technical work. The statistic that we'll throw at you again is, when dealing with accounting for loans and capital leases, is Intuit, the makers of QuickBooks. They did a survey for business owners on their financial literacy in terms of their business, and what they found was 82% of the business owners got a score of 70% or less. So less than 70% when it dealt with basic financial statement items. And what we have here is we have business owners, they don't really know how to account for the loans or capital leases properly, and as a result they have these income statements and they don't make any sense whatsoever. As a result, they're not going to understand the cash flow. So, Cole, what are the questions that these business owners should be asking?
Should each loan account have a separate balance sheet account?
Yeah, 100%. So every loan account that we have, if we have an operating loan and we have mortgage number 1 or mortgage number 2 and equipment loan number 1, they should all have separate accounts on the balance sheet. We shouldn't be commingling those loan accounts at all under any circumstances. Those are always kind of separate.
Should the monthly payment be posted to the balance sheet or income statement?
Yeah, so if you have a loan, that monthly payment should be posted to the balance sheet. Most of the time, almost all of that deals with the principal payment. Or the majority of it is going to deal with the principal payment. Now, there is the interest component does belong on the income statement. Sometimes it's really obvious from the bank statement how much is interest and how much is principal. And if that's the case, you should put the interest payment on the income statement and the principal portion on the balance sheet. If it's not obvious, this might be something that's not worth doing a loan amortization schedule every month. Just put that payment on to the balance sheet. Because we're talking about repaying a principal loan to buy capital assets. They don't belong on the income statement. So we have to, understand that they're going to completely overshadow that income statement if we're looking at, the payback on a loan. So, if we know the interest component, put that on the income statement. But if not, if we're just looking at the payment, the principal payment, or the unknown parts of the payment, put it all on the balance sheet in their individual loan account.
Why do you need enough income to cover these principal payments?
So ultimately, because those payments are not on your profit and loss statement, you need enough income to pay it. So if we have a $2,000 a month principal repayment of a loan and we have $0 in income, we're going to have negative $2,000 in cash flow. But if we have $2,000 on our income statement and we use that $2,000 to pay back our loan, we're okay. Now we're kind of cash flow at scratch, if you will. So we need enough income to cover the principal payments of those loans.
Why are there positive and negative current portion accounts?
So the positive and negative current portion accounts are a factor of most accountants' software. So this isn't the software that most businesses, the QuickBooks, or simply accounting file that you're using, but most of the software that accountants use at the year-end preparation, they have to separate out the current portion of the loan. So you have a loan and you owe $100,000 on that loan, and you're going to pay back $10,000 next year and the other $90,000 in upcoming years. That $10,000 has to be separated on the financial statements as the current portion of the loan. So what happens is there's almost like a placeholder account that says the $10,000, that's the current portion. We know the whole $100,000 is sitting in the account that you use in your QuickBooks file or your Simply Accounting file. But we have another account, the current portion, so we can put it on the balance sheet. But then we also have to have an offset. So it's really just a placeholder account. You're just going to have, for example, you'd have one $10,000 account, one negative $10,000 account, and they essentially just cancel them off. The average small business owner can almost just disregard those current portion accounts and just post all the payments to the main loan account.
Why should you see a consistent decrease to the main loan accounts each month?
That shows that the monthly payment is happening. So if you have the loan account, in 1 month it was 100,000, the next month it was 99, the month after it was 98, and the month after it was 97, things are looking good. But then if it sticks at 97, there's generally one of two things that has happened. Either there's a mistake and it wasn't posted to that loan account, or we didn't have enough money in the loan account and didn't get paid. But we should see that decrease every month to reflect the payment.
What are some likely causes if there's no change in the loan account 1 month?
Yeah, it's usually going back to that. It's usually the it's been misclassified. So that's normally what's happened. I mean, it could be that it didn't get paid. That is a likely concern. Most banks, they have these things on autopilot and it's automatically coming out of the account unless it bounced from the account. So the likely cause is it's probably sitting somewhere else, and it's probably sitting on your income statement. So which is going to completely skew your income statement. And it's not going to give you an idea of how much you're actually making in this business. It can also be, if you have multiple loan accounts, one of the other common mistakes is it's in the wrong loan account. So you have loan payment A in loan account B. That's another very likely cause that happens. So you should just take a bird's eye view. Again, we're always recommending the 6-month comparatives to review your monthly comparative balance sheet, and you should see those loan accounts going down by a set amount or a reasonably similar amount each and every month. And if there's no change in 1 month, either we missed the payment, we have a classification error, or we have the wrong payment in the wrong account.
Are there certain types of leases that are accounted for like loans or rent?
Yeah, so they're called capital leases. So if you have a capital lease, what that means is, although the legal structure of the transaction is a lease, really it takes the form, the spirit of the transaction is more ownership in nature. And for accounting purposes, we basically book and record those capital leases the same way we would record a loan, as if you had bought an asset and took a loan out to acquire that asset. So they're recorded in that manner, as opposed to just putting the rent payment as an expense on the income statement. So they're recorded as, hey, let's put the asset on, let's put the liability that's associated with that asset on, and every time you make a payment on it, let's book that payment against that liability.
What happens if a lease has a discount buyout option at the end of the term?
So that's one of the criteria for determining if this is a capital lease or an operating lease. So you have this $100,000 piece of equipment, and at the end of the term you're going to use this thing for 5 years, and at the end of 5 years you would expect that asset is worth $20,000. Off the lot it was $100,000, used it's worth $20,000. But let's say at the end of the lease you have the option to buy it for $1. Really, you own this thing. You're not going to buy this asset for $1 at the end of the lease. It's a discount purchase option, and it's one of the criteria that if you have that characteristic of the lease, this is a capital lease, and it's really an ownership structure at this point.
What happens if the lease term is for more than 75% of the asset's lifespan?
Yeah, so that's criteria number 2 is, is if the lease is for 75% or more of the asset's useful economic life, you own this thing. Let's say you buy this piece of equipment, and this piece of equipment is really only expected to last, let's call it 8 years, and the lease goes for 7 years. You own this thing. This is not a lease. This is not an operating lease. This is a capital lease, and we should be recording it on the financial statements as such to give you an accurate picture of what's happening. So you're recording that asset is actually yours, and that entire liability that's going to come as that lease is more like a loan than really just a monthly lease payment.
What happens if the present value of the lease payments is 90% of the fair value?
Well, you're getting technical now, Cole. So the 90% test of the fair value. So what we're saying is, we have this asset and the fair value is $100,000, and we're talking about the present value of those lease payments. So the asset's worth $100,000 if you bought it in cash right now, and let's say all the lease payments in total are going to be, I'm just going to call it $150,000. Now, keep in mind, $1 paid 7 years from now is not the same value as $1 paid today. There's the time value of money. That's when it talks about the present value, and we can discount that back mathematically. And let's say if we find that those $150,000 worth of lease payments, they have a present value of say, $95,000. Really, this is more like ownership than it is like a monthly lease. Like you go to, budget or rent a car. That's a clear lease. You don't own this thing, but if the payments that you're going to fork out as your contractual obligation are, the present value of them is more than 90% of the fair value of the asset on it when it's coming in. You own this thing, and it should be recorded as such.
Can reporting capital leases properly help a business get more financing?
It can, yeah. So sometimes we have this capital lease, this leased equipment, and think about it. Like, let's say the banker is looking at this lease expense every month. Well, what if they were to understand that capital lease and they know that this lease expires in 6 months, and in 6 months they're going to get the ability to buy this piece of equipment at a discount rate, say $1. That changes the entire cash flow outlook of this business. Oftentimes there's, when we go to a lot of the optometry clinics that they deal with, and there's a lot of, upfront costs in acquiring that equipment. But, we're talking 5 or 7 years in, and all of a sudden all those lease payments come off the book, and they have that free cash flow now coming in. Whereas if we were just recording it as a month-to-month expense, it just looks like that expense is going to occur in perpetuity. But if you start to understand what that capital lease looks like and the terms of the capital lease, it can make the business look, more or often it's either more or the same, but it can be more favorable for the business owner. The cash flow outlook looks better. So I think that's what we have for you today on accounting for loans and capital leases. Thanks again for tuning in. Please hit the like and subscribe button so we can continue to deliver you tips on how to beat the odds at business. And if you have any questions or queries, feel free to leave them in the comments below, and we'll do everything we can to address them and potentially make them a topic in a future video. Thanks very much.
Thank you.